Warren Buffett just did something he's only done twice before in 60 years. And both times, within 12 months, the market crashed. He moved $325 billion into cash, the largest cash position in Berkshire Hathaway's history, 50% larger than before 2008, almost 3 times larger than before COVID. And he's not buying anything. He sold half of Apple. He's dumping Bank of America. He's sitting on more cash than the GDP of Finland. The last time he did this, 2019. COVID crash came 4 months later. Before that, 2007. The financial crisis destroyed 57% of the market. Now it's happening again. $325 billion in cash. And if the pattern holds, something catastrophic is coming in the next 6 to 12 months. But here's what you need to understand. Buffett isn't panicking, he's positioning. Because there are 3 specific assets that have survived every major crisis in the last 100 years. And by the end of this video, you're going to see exactly what they are, why they work, and how to position yourself before whatever's coming arrives. Because the people who survive the next crash will be the people who understand this pattern. Let me show you something that's going to change how you see money forever. I'm going to walk you through 5 completely different economic disasters. The Great Depression, where stocks fell 89%. The 1970s stagflation, where inflation destroyed savings. The 2008 financial crisis, where $10 trillion vanished. COVID, where markets crashed 35% in 3 weeks. And 2022, where growth stocks fell 70%. 5 totally different catastrophes, different causes, different triggers, different outcomes for almost everyone. But 3 positions survived all of them. And not just survived. They positioned their holders to buy at the bottom and compound for decades afterward. Here's the part that should terrify you. Most people don't hold these 3 positions. They're chasing returns, they're buying what's hot, they're concentrated in tech stocks or crypto or real estate. And when the crash comes, they're going to lose everything. Not because they're stupid, because they don't understand the pattern. Let's start with position 1. And I need you to hear this with fresh ears, because you've been lied to about this asset for 15 years. I know what you're thinking. Cash loses to inflation. Cash is trash. Cash is for people too scared to invest. But let me show you what actually happened during 5 crises when everyone else was getting destroyed. Great Depression. 1929 to 1933. While stocks were collapsing 89%, while banks were failing by the thousands, while people who bought on margin were jumping out of windows, cash was doing something remarkable. It was gaining purchasing power. Prices fell 25% during the Depression. That's deflation. If you held $1 in 1929, by 1932, you could buy 25% more stuff with that same dollar. But it gets better. Treasury bills were paying 3 to 4% interest during this entire period. So you made 3 to 4% in interest, plus gained 25% in purchasing power. That's a 28 to 30% real return, while stocks lost 89%. Let that sink in. The safest asset on earth outperformed the stock market by over 100 percentage points. Bernard Baruch, one of the wealthiest men of that era, held massive cash positions through the entire crash. He didn't try to catch falling knives. He didn't average down. He just waited. Then in 1932 and 1933, when stocks were trading for less than the cash on corporate balance sheets, when entire skyscrapers were selling for the price of their lobbies, he deployed. He bought everything at 10 cents on the dollar. By 1936, he was significantly wealthier than before the crash. Not because he predicted it, because he had capital when nobody else did. Now fast forward to 2008. Warren Buffett held $40 billion in cash going into the financial crisis. Not because he knew Lehman Brothers would fail. He always holds cash. But when Lehman collapsed in September 2008, when the entire financial system was hours from complete meltdown, Buffett had something nobody else had. Liquidity. He deployed $5 billion into Goldman Sachs, $3 billion into General Electric, $5 billion into Bank of America. Those 3 investments alone made Berkshire Hathaway tens of billions of dollars. Not from genius stock picking, from having cash when everyone else was desperate for it. COVID 2020. Bill Ackman held significant cash positions going into the pandemic. When markets crashed in March, he bought $27 million worth of credit default swaps, betting on corporate debt collapse. Those swaps paid out $2.6 billion, 100 times return in 3 weeks. He immediately deployed that cash into Starbucks, Hilton, and Lowe's at 40 to 50% discounts. Those positions doubled in 4 months. Again, not because he's a genius, because he had cash and conviction when markets were panicking. 2022 bear market. This is where cash really proved its value in a different way. Treasury bill yields went from 0% to 5% in 1 year. If you held T-bills, you made 5%. The S&P 500 fell 18%. That's a 23% outperformance just by sitting in the safest asset on earth. Now here's where this gets absolutely insane, and this is the part you need to pay very close attention to. Right now, Warren Buffett holds $325 billion in cash and treasury bills. That's 30% of Berkshire Hathaway's entire market value. He sold half of his Apple position. Apple was his largest holding, his crown jewel. He cut it in half. He's been steadily selling Bank of America for months. He's not buying anything new, just accumulating cash. And here's the pattern that should make your blood run cold. In 2007, Buffett held $40 billion in cash, largest position at that time. The 2008 crash came 12 months later. In 2019, he held $120 billion in cash. People mocked him. They said he lost his touch. He was too old. He didn't understand tech. COVID crash came 4 months later. Now, $325 billion. What does that tell you? It tells you the greatest investor in history sees something coming, and he's positioning for it. But here's the problem with cash. It has one fatal weakness. It protects you during deflation and crises, but it gets obliterated during inflation and currency debasement. That's where position 2 comes in. And this is the asset central banks are stockpiling right now at rates we haven't seen in 70 years. And I need you to understand something. I'm not talking about gold because it's shiny or because of some romantic notion about sound money. I'm talking about gold because the historical data is absolutely undeniable. Great Depression. Gold was fixed at $20.67 per ounce by law. You couldn't profit from it directly during the crash. But in 1934, Franklin Roosevelt did something extraordinary. He devalued the dollar by revaluing gold from $20.67 to $35 per ounce. Overnight, anyone holding gold saw a 69% gain. Wealth was preserved during the crash, then multiplied during the currency devaluation. But the real test of gold wasn't the Depression. It was the 1970s, and this is where it becomes absolutely critical to understand. 1970s stagflation is the nightmare scenario that breaks every traditional portfolio. Stocks go nowhere for a decade. Bonds get destroyed by inflation. Savings accounts lose purchasing power every single year. Gold in 1970 was $35 per ounce. By 1980, $850. That's a 24 times gain in one decade. Not 24%, 24 times. A $10,000 position became $240,000. It wasn't just the best performing asset of the 1970s. It was the only major asset that thrived. Everything else either stagnated or got crushed. 2008 financial crisis. Gold was $850 in early 2008. During the initial panic in September and October, it fell to $700. Everyone said gold was done. Then the Federal Reserve printed $1.5 trillion in quantitative easing. Gold reversed. $1,200 by 2009, $1,900 by 2011, more than doubled from the panic lows. Why? Because the market understood that printing trillions to solve a debt crisis means currency debasement, and gold is the ultimate hedge. COVID 2020. Gold was $1,550 in January. Fell to $1,450 during the March panic as everything was sold for cash. Then the Fed printed $4 trillion. The government sent stimulus checks. Inflation was coming and gold knew it. Gold hit 2070 by August 2020, a 42% gain in 5 months. The pattern is obvious. Crisis hits, gold dips briefly as people panic, sell everything. Then central banks print money to solve the crisis. Gold explodes as currency gets debased. Now here's what's happening right now, and this should make you sit up and pay attention. Central banks bought over 1,000 tons of gold in 2022, over 1,000 tons in 2023, over 1,000 tons in 2024. That's the highest 3-year accumulation total since 1950, since they started tracking this data systematically. China officially increased reserves from 1,000 tons to over 2,000 tons. But analysts believe it's much higher. They're not reporting everything. Russia liquidated U.S. treasuries and bought gold. Poland doubled its reserves. Turkey, India, Singapore, all accumulating at record rates. Why? Because they see the same thing Buffett sees. $36 trillion in U.S. debt. No way to pay it back except printing more money. And when you print money, you debase the currency. Gold can't be printed. It can't be digitally created. It requires physical mining. Supply is limited. Demand from central banks is exploding. Gold hit $2,700 in 2024, all-time high. And it's not because of retail speculation. It's because the people who control trillions are buying. So now we've got cash for deflation and crisis protection, gold for inflation and currency debasement. But we're still missing something critical. We need exposure to actual economic growth. We need productive assets that generate earnings and compound over decades. That's position 3. And this is going to surprise you because it's so simple, most people overlook it. Before you roll your eyes and think this is just generic buy and hold advice, let me show you what actually happened during our 5 crises. Great Depression. The S&P fell 89% from 1929 to 1932. Catastrophic. Generational wealth destroyed. But here's what nobody talks about. By 1945, the S&P was back to, even if you reinvested dividends, By 1950, it doubled. By 1960, it quintupled. Yes, the recovery took 30 years, but it happened. Anyone who held through the worst crisis in modern history still came out ahead. More importantly, the people who bought during the Depression made fortunes. If you bought in 1932 at the bottom, you made 10 times your money by 1945. 1970s stagflation. Everyone thinks stocks failed during this period. In nominal terms, they're right. The S&P was flat from 1968 to 1982. But with dividends reinvested, you made 5 to 6% annually. You didn't get rich, but you survived. And here's the key. In 1982, when inflation finally broke, when Paul Volcker raised rates to 20%, when everyone was terrified of recession, stocks bottomed. From 1982 to 2000, the greatest bull market in history. 17% annual returns for 18 years straight. The people who held the S&P through the terrible 1970s captured the entire 1980s and 1990s boom. The people who sold in frustration in 1979 missed everything. 2008, financial crisis, S&P fell 57% from October 2007 to March 2009. Everyone thought capitalism was over. The index recovered by March 2013. 4 years to get back to even. Then from 2009 to 2020, 400% return. 100,000 invested at the March 2009 bottom became 500,000 by 2020. Even if you bought at the October 2007 top and held through the crash, you still had 300,000 by 2020. You just had to survive the middle. COVID 2020. S&P fell 35% in 23 days, fastest crash in history. 3,400 down to 2,200. Recovered by August, 6 months. Hit 4,800 by December 2021. Doubled in under 2 years. 2022 bear market. S&P down 18%. Everyone calling for recession. Tech stocks down 70%. Then 2023 up 25%. The people who panic sold at the October 2022 bottom missed the entire recovery. Here's the pattern that matters more than anything else. Over any 15-year period in history, the S&P 500 has never delivered a negative return. Not once. It doesn't matter when you bought. If you held for 15 years, you made money. Every single time. Why? Because you're not betting on one company. You're owning 500 of the largest, most profitable companies in the world. Apple, Microsoft, Nvidia, Amazon, Google, Berkshire Hathaway. These companies adapt. They survive recessions. They fire workers, cut costs, buy back stock. They emerge stronger. And over long periods, earnings grow. The American economy grows. Innovation happens. Productivity improves. Stock prices follow earnings. It's not magic. It's capitalism with time to work. So now we've got the three positions. Cash and T-bills for crisis protection and buying power. Physical gold for inflation and currency debasement. S&P 500 for long-term growth. But here's the question everyone asks. How much of each? The answer depends on one thing, your age. Specifically, how much time you have to recover from a crash. If you're under 40, you can afford more risk. You have 25 plus years until retirement. You have time to recover from a 50% crash. 20% cash and T-bills. 10% gold. 70% S&P 500. The cash gives you dry powder if opportunity comes. The gold protects against currency collapse. The S&P gives you maximum long-term growth. If you're 40 to 60, you need balance. You have 10 to 25 years until retirement. You can still recover, but you can't be reckless. 30% cash and T-bills, 10% gold, 60% S&P 500. More defensive, still growth-oriented. If you're over 60, you're in or near retirement. You cannot afford a 50% loss. You don't have 10 years to wait for recovery. 40% cash and T-bills, 10% gold, 50% S&P 500. Conservative, focused on preservation over growth. Now let me show you exactly how to execute this, because theory without implementation is worthless. Position 1, cash and treasury bills. 2 options. Option 1, buy treasury bills directly through Treasury Direct. Government website. No fees. You can buy 4-week, 8-week, 13-week, 26-week, or 52-week T-bills, currently yielding 4 to 5%. Zero risk. Backed by the U.S. government. Option 2, money market funds. These invest in T-bills and short-term government debt. Slightly lower yield because of fees, but more liquid. You can access money instantly. Position 2, physical gold. 2 options. Option 1, buy physical gold from a reputable dealer. Bars or coins, doesn't matter. Store it yourself or in a secure vault. Pros, you actually own it. Nobody can confiscate it. Cons, storage costs, insurance, liquidity issues if you need to sell fast. Option 2, GLD or IAU ETFs. These hold allocated physical gold in vaults. Every share represents specific gold bars. More liquid, easier to trade, no storage hassles. Slightly higher fees, but worth it for most people. Position 3, S&P 500 index, 3 options. SPY, the original S&P 500 ETF. Highest volume, tightest spreads, slightly higher fees. VOO, Vanguard's S&P 500 ETF. Lower fees, great for long-term holders. IVV, iShares S&P 500 ETF. Also low fees, essentially identical to VOO. Pick one. Doesn't matter which. Dollar cost average monthly. Don't try to time it. Just consistently invest over time. Now here's why 3 specifically. Why not 4 positions? Why not 10 different strategies? Because markets fundamentally operate in 3 states, and each position addresses one state. State 1, deflation and crisis. Asset prices falling, credit contracting, people desperate for liquidity, cash dominates. State 2, inflation and currency debasement, paper money losing value, central banks printing, you need hard assets, gold dominates. State 3, growth and recovery, economy expanding, companies earning profits. You need productive assets, stocks dominate. Every crisis in history falls into one of these 3 states or transitions between them. The Great Depression was pure state 1. Deflation, cash 1. The 1970s was pure state 2. Inflation, gold 1. 2008 started as state 1, then transitioned to state 2 when the Fed started printing. Cash won early, gold won later, stocks won eventually. COVID was the same pattern compressed. State 1 crash in March, immediate transition to state 2 as 4 trillion got printed. Cash won in March, gold and stocks won from April onward. 2022 was a transition from state 2 back to state 1. Inflation peaked, Fed raised rates, growth crashed. T-bills paid 5% while everything else fell. The point is simple. You never know which state is coming next, or how long each state lasts, or when transitions happen. But if you hold all 3 positions, you're protected regardless. This is Ray Dalio's all-weather portfolio concept. Not designed to be best in every environment. Designed to survive every environment. You won't beat the market in a raging bull run. You also won't get destroyed in a crash. You trade maximum upside for survival. And over a lifetime, survival compounds into serious wealth. Now let me tell you why I'm making this video right now. Why the urgency? Because we're seeing warning signs that look identical to every previous crisis. Buffett holding $325 billion in cash. Largest ever. He's positioning for something. Central banks buying gold at rates not seen in 70 years. They're worried about currency collapse. U.S. debt at $36 trillion. Interest payments now exceed defense spending. Completely unsustainable. The Fed printed $15 trillion in 15 years. More money created than in the previous 230 years combined. Corporate debt at record highs. Consumer debt at record highs. Government debt at record highs. At some point, something breaks. It always does. I don't know when. Maybe next year, maybe 5 years from now. Nobody knows. But I know this. When it breaks, people who are positioned will be fine. People who aren't will get destroyed. And positioning doesn't mean going to cash and hiding. It means holding all 3 positions so you survive whatever comes. If deflation hits, your cash protects you and gives you buying power. If inflation hits, your gold protects you and probably multiplies. If we get growth, your S&P position captures the upside. You win in all scenarios. Maybe not maximally, but you win. Now let me tell you what happens if you don't position. If you're 100% in stocks and deflation hits, you lose 50 to 70%. You panic sell at the bottom. You lock in losses. You miss the recovery. If you're 100% in cash and inflation hits, you lose 20 to 30% purchasing power. Your savings evaporate while you watch. If you're 100% in gold and we get a decade bull market, you make nothing while stocks quadruple. Single position portfolios are gambling. You're betting on one outcome. If you're wrong, you lose everything. 3 position portfolios are survival. You accept you don't know the future. You position for all possibilities. Here's what I want you to do. Not tomorrow, right now. Open a spreadsheet. Write down your current allocation. How much cash? How much gold? How much stocks? Compare it to the age-based allocation I gave you. If you're massively overweight stocks, you're at risk in a crash. Start moving some to cash and gold. If you're massively overweight cash, you're at risk in inflation. Move some to gold and stocks. If you have 0 gold, you're at risk in currency debasement. Start with 5%. Work up to 10. You don't have to do this overnight. Dollar cost average over 3 to 6 months. But start today, because one thing is certain. Another crisis is coming. We don't know when. We don't know what kind. But it's coming. They always come. And when it does, you'll either be positioned like Buffett, like central banks, like the people who survived every previous crisis, or you'll be positioned like everyone else, and everyone else gets destroyed. 5 crises. 100 years of data. 3 positions survived them all. Cash and T-bills for crisis protection. Physical gold for inflation protection. S&P 500 for growth. Not complicated, not exciting. But it works. And in the end, that's all that matters.